Hello everyone. Today we are going to cover the Excel part of chapter number 6. And then in this particular lecture, we're going to discuss how to prepare a statement of shareholders equity, a statement of cash flows, and then we also discuss how to calculate free cash flow to the firm. We are going to also find how a firm uses free cash flow to the firm in a particular year. And then we're going to also calculate some ratios to evaluate the performance of the same firm. All right, then let us start. Here you can see the balance sheet information for a particular firm in the year 2021 and 2022. We also have the information for the income statement accounts for the same time periods. Now, based on all of this information, we need to first prepare a statement of shareholders equity, followed by the statement of cash flows. Let us start. We're going to first copy the balance of the statement of shareholders equity from the previous year, which is year number 2020. And then we are going to prepare the statement of cash flows for the year 2021. So here, the basic format is you're going to start with the balance of the shareholders equity accounts for the year of 2020. Then you're going to put the changes in the shareholders equity accounts during the year 2021. Then you're going to find the balance of the shareholders equity accounts for the year 2021. Right, let us start. The value of preferred stock here is $100. Number of common shares, we get it from income statement, is 60. And then value of common stock, that means the face value or paid up capital here is 500. Retained earnings 1552. Then total equity here is 2125. Let us match. So here you can see the value of total equity here is 2152. And then in the balance sheet, you can see the value of common equity is 2052. And then in our total equity accounts, we have equity from the preferred stockholders, and we also have equity from the common stockholders. So the equity for the common stockholder here is 2052, and at the same time we also have $100 equity from the preferred stockholder. So the sum of both of these accounts here will give us total equity, which is 2152. So we got the right total equity amounts at the end of year number 2020 and at the beginning of year number 2021. Now let us include the changes in the statement of shareholders equity during the period 2021. First, net income for the year 2021 is equal to 248. And then during the time period, the company paid some cash dividends to its common stockholders, and then the dividend is their cash outflow, so the sign should be negative. So negative dividend amount, you can see dividend amount is how much? 60. So these are the only changes. During the time period, the company did not repurchase any stock or issued any stock. If the company repurchase any stock, then basically they have cash outflow here. So the sign of the cash flow should be negative. Whenever they issue new stock, then they get money. So the sign should be positive here. Okay, now let us calculate the balance of the shareholders equity accounts at the end of year number 2021. So here you can see the balance of total equity at the end of year number 2021 is 2340. Now let us match this value with the value reported for the total equity in the balance sheet. So here you can see total common equity at the end of year number 2021 is 2240. On top of this account, we also have 100 from preferred stock account. So the sum of preferred stock account and total common equity account will give us total equity equal to 2340. That is exactly what we get as the ending balance of total equity in our statement of shareholders. Now, our statement of shareholders equity for the year 2021 is complete. Let us now move to the statement of cash flows. Here, we are going to first start with our net income we reported in our income statement. So net income for the preferred shareholders before preferred dividends is 255. Again, net income before preferred dividend reported in the income statement is 255. Now, let us add up the non-cash expenses, because non-cash expenses are reported as expenses in our income statement, but they are not our true expenses. So we are going to add them back to our net income in order to get our true operating cash flows. Now, depreciation here reported in the income statement for the year 2021 is 200. Next, increases in the current assets account and the increases or decreases in the current liabilities accounts. Okay. So under operating activities, we are going to report the changes in the current assets account except the changes in the cash and cash equivalent account and the changes in the short-term investment accounts. On the other hand, whenever we are going to report the current liabilities accounts to the operating cash flow section of the statement of cash flows, we are going to consider all the current liabilities accounts except the debt accounts. So debts account should be reported under financing activities, not under operating activities. Okay. Now, the next concept here, whenever current assets account goes up, whenever the value of the current asset accounts goes up, then what happens? Then basically you have cash outflows. Let me just give you one simple example. Whenever your value of total inventories changes from the previous year to this year, that means you actually added up more inventories, and to add up the additional inventories you had to pay money. So it is your cash outflow. So increases in the current assets accounts applicable to the working capital calculation should be your cash outflow. Likewise, decreases in the current assets accounts applicable for the working capital adjustment should be your cash inflows. On the other hand, increases in the current liabilities accounts is your cash inflows, and then increases in the value of the current liabilities accounts, decreases in the value of the current liabilities accounts should be your cash outflows. Now, let me just give you one simple example. accounts payables. So accounts payables records your credit purchases. So whenever your credit purchases during a particular year goes up, then what happens? You are actually getting some fund from the merchandiser. So merchandiser are providing you the cash. So increases in the accounts payables reflect your cash inflows. Likewise, decreases in the accounts payable reflects that you actually paid off your credit for your credit purchases. So therefore, decreases in your accounts payable reflects cash outflows. So here, increases in accounts receivables, you already know this should be your cash outflow. So the sign should be negative. Then increases in inventories, again, the sign should be negative because it is your cash outflow. The increases in accounts payable is your cash inflow, so the sign should be positive. So we are not going to put any negative sign here. Now we can calculate net cash flows provided by operating activities. Sum up all the accounts we put under operating cash flows. And the net cash flows provided by operating activities here is 163. Next, net cash flows provided by investing activities. Now let us see how much cash we spent to acquire fixed assets. So the money we spend for capex or acquiring fixed assets is our investment, and whenever we invest, it is our cash outflows. Whenever we divest, that means we sell off our assets, it is our cash inflows. Okay. Now let us calculate our ending value of our total fixed assets in the year 2021. So you can see we have here net PPE $2,000, but net PPE is not the ending balance of our PPE or real cost for our PPE by the year 2021. We actually reduced our gross PPE by the depreciation amount in the year 2021. So let us add it back. So now we get our gross PPE in the year 2021 or by the end of the year 2021. Then we started the year 2021 with the ending balance of net PPE in the year 2020. Now you can see here our investment for fixed assets during this year is 420. Because it is our investment, we are going to put a negative sign here to reflect cash outflows. Then during this time period, we also sell some of our short-term investments. And whenever we sell our short-term investments, we actually get money. Whenever we invest in short-term investments, we pay money. So sale of short-term investment should be your cash inflow. Now we are going to make it positive because it is cash inflow. Now let us calculate our total cash flows provided by investing activities. Next, cash flows provided by financing activities. So here, our financing cash flows are provided by both shareholders and debt holders. Now here, let us see if we get any money from the debt holders in the form of short-term debt and long-term debt. If we get money from the debt holders, then it is our cash inflows. If we pay money, it is our cash outflows. Then our payment for common stock and preferred stock dividend is our cash outflows whenever we pay dividend. At the same time, whenever we issue new shares, then basically it is our cash inflows. Now, let us see. In this particular year, our notes payable increased. That means it is our cash inflow. Then during the same time period, our total bond value also increased. That means we had some inflows. And then we paid some dividends during the time period, so it is our cash outflow. So you can see here preferred dividend and then common dividend. Let us now calculate total cash flows provided by financing activities. Okay. Now let us see the net changes in cash and cash equivalents during the year 2021. So add up all the cash flows provided by operating activities, investing activities, and financing activities. Then let us also include beginning balance of our cash and cash equivalents. Then the ending balance of our cash and cash equivalents is $100, which is exactly we have here $100. Okay, so now our statement of cash flows is also ready. Now let us calculate net cash flow. So net cash flow is the sum of net income and depreciation. So let us first include net income and then depreciation. So net cash flow in the year 2021 is 448, and the net cash flow in the year 2020 is 473. Okay. Now let us discuss free cash flow to the firm. So free cash flow to the firm is the cash flows available to the firm after paying off all of its operating expenses and required investment expenses. So this is the cash flow the firm has available to distribute to its different securities holders and for some other investments. Now, here you can see the free cash flow is the difference between net operating profit after tax and changes in the operating capital. Then net operating profit after tax formula is this. So to calculate net operating profit after tax, you need to know earnings before interest and tax and the tax rate. Then to calculate changes in operating capital, you need to first calculate operating capital for the year 2021 and then operating capital for the year 2020, then the changes in the operating capital from the year 2020 to 2021 will be your changes or net investment in operating capital. Then operating capital in a particular year is the sum of net operating working capital and net fixed assets. Here you can see net operating working capital here is the difference between operating current assets and operating current liabilities. So we are gonna calculate each of these accounts one by one before we calculate the free cash flow to the firm finally. And you remember, in order to calculate free cash flow to the firm, you need to know net operating profit after tax and changes in operating capital. Okay. First, let us calculate net operating profit after tax. And here you know the formula is EBIT adjusted for the tax rate. First, let us copy the tax rate. Next, EBIT. Then 1 minus the tax rate. The net operating profit after tax is EBIT adjusted for tax. So here we got our net operating profit after tax. All right. Now let us calculate our net operating working capital. So net operating working capital is the difference between operating current assets and operating current liabilities. So first let us calculate operating current assets followed by operating current liabilities. And then here, as you can see here, operating current assets include all the current assets accounts except short-term investment accounts. On the other hand, operating current liabilities accounts include all the current liabilities accounts except the short-term debt accounts or current portion of the long-term debts accounts. Okay. So here in this particular case, we have short-term investment. Besides short-term investment, we have current cash and cash equivalents, account receivable, inventories in the total current assets calculation. So we are going to include these three accounts except short-term investment to get our operating current assets. Then operating current liabilities. Here you can see in our current liabilities section, we have just one debt accounts. So we are not going to include this debt account in our calculation for operating current liabilities. So besides, other than this account, we are going to use the other accounts to get our operating current liabilities, and those current other accounts include here accounts payable and then accruals. Now let us calculate our total operating current liabilities. Now let us calculate our net operating working capital, and the net operating working capital, as you can see here, is the difference between operating current assets and operating current liabilities. All right, so operating working capital in the year 2021 is 1000, and then this same account has $710, 710 balance in the year 2020. Okay, now let us calculate net operating capital in a different way. So in this case, okay, first let us calculate our net operating capital here. So net operating capital here, you know, is the sum of net operating working capital and net fixed assets. So let us copy the net operating working capital we just calculated, and then net PPE we have in the balance sheet. Now, as I said, now let us calculate net operating capital in a different approach. And in that approach, we are going to calculate total of net operating capital by calculating total investor supplied operating capital. And then the total net operating capital and then total investor supplied operating capital should have the same value, because at the end, it is the investors who provide the total net operating capital directly by making investment or indirectly by retained earnings. Okay, so first let us calculate total funds provided by the investors, and then those funds come from three sources. First, from the bondholders, second from the preferred stockholders, third from the common equity holders. Okay. First, let us find the investment provided by debt holders. So in this case, debt holders provide notes payable for short-term financing and long-term bonds for the long-term financing. Now let us include the financing provided by the preferred stockholders. Then let us now include financing provided by common equity holders. And financing provided by common equity holders is the total common equity, which consists of common stock and retained earnings. So now we have our total common equity value here. Next, add all of these accounts up to get total investor supplied funds. Then we are gonna calculate total investor supplied operating capital. So it is the difference between total investor supplied capital and short-term investment. And we get short-term investment from the current asset side of the balance sheet. Now let us compare. So you can see in both approaches, we get the same value for the total net operating capital. All right. Now let us calculate the free cash flow to the firm. we can see free cash flow to the firm is the difference between net operating profit after tax and changes in the operating capital. Okay, so first let us calculate changes in total operating capital. So we have our total net operating capital calculated here for the year 2021 and 2020. Then let us now calculate the gap or changes in the total net working capital from the year 2021 to from the year 2020 to 2021. Okay. Now, net operating profit after tax for the year 2021 is 300, and then investment or changes in net operating capital is 510. Then free cash flow to the firm is NOPAT minus changes in total net operating capital. All right. Now let us calculate free cash flow in a different approach. So in this approach, we're going to first calculate our operating cash flows, and operating cash flows here is the sum of net operating profit after tax and depreciation, and then we are going to calculate our investment, and our investment is in fixed assets and in net operating working capital. Okay. So now let us see. Our NOPAT and depreciation here is NOPAT $300, then plus your depreciation for the year 2021 is 200. Then gross investment in fixed assets. We already calculated our gross investment in fixed asset in the year 2021 in our statement of cash flows. Let us get that value from the statement of cash flows, and here cash used to acquire fixed asset in the year 2021 420, and in this particular equation we don't need to have negative or positive sign because the equation will automatically consider negative values and positive values. Then investment in net working capital, in other words changes in net working capital from the year 2020 to 2021. So net operating working capital from the year 2020 to 2021. Now let us calculate free cash flows. So operating cash flows minus investment in fixed asset minus investment in net operating working capital, and again you can see free cash flow with the firm is negative $210. Okay. Now let us see how the firm uses its free cash flows in the year 2021. Okay. First, let us see how much the company spent to pay off its after-tax interest expenses. So pre-tax interest expense during the year 2021 60. Then 1 minus tax rate, 1 minus, we already know our tax rate here, 25%. Equal 1 minus our tax rate, 25%. Then our after-tax interest expense is 45. Now let us see how much free cash flow the company uses for net repayment of debt or issuance of debt. All debt at the end of the current year. And we know we have two types of debt. One is notes payable and the other one is long-term bonds. And all debt in the previous year. you can see here. So debt accounts, the value of the debt accounts actually increased from the year 2020 to 2021. So the company received money here. Right. Next, total dividend payment. The company paid preferred dividend and common dividend here. So preferred dividend is 7. Then common dividend is 60. So total dividend the company paid is 7 plus 60. Next, repurchase stock. Now, let us see preferred stock and common stock at the beginning of the year. That means in the year 2020. So preferred stock and common stock in the year 2020 is 100, 500. Again, preferred stock and common stock in the current year, 100 plus 500. So you can see no change in the total value of these accounts. All right. Next, let us see how much free cash flow the company spent to purchase their short-term investment. So short-term investment in the year 2021 is 10, and then short-term investment at the beginning of the year, that means at the end of year number 2020, is 40. So in this case, the company actually does not purchase, it actually sells some short-term investments. Okay, now let us see here summary of the uses of free cash flows. So here you can see all the uses, that means all the outflows should have the positive sign and all the inflows should have the negative sign, because here we are now calculating uses, right? Okay, so whenever we pay interest we have cash outflows, so the value should be positive. And then net payment or issuance of debt. So here you can see we actually issued debt in the current year. That means we got money. So whenever we got money, it is not uses. It is some additional, cash flows or inflows. So the sign here should be negative. Then total dividend payment, again it is expense. So expense accounts or outflows should be positive here. Then again, net repurchase of stock, value is 0. Then net purchase of short-term investment. So here, purchase of investment. So purchase means what? Cash outflow. So we here calculated purchase. So we are not gonna put any negative sign. It is whatever it is. We are gonna just directly copy it, because purchase, right? Purchase is cash outflows. But here your purchase account is negative. That means you actually sold. So automatically you can see here you get negative sign here. So whenever you have negative sign, it is what? It is your cash inflows. Okay. Now you sum them up. You can see the uses of the value of the total uses of free cash flow is equal to the free cash flow value you calculated earlier. So now here you can say the firm here used free cash flow to the firm to pay off its interest expenses, dividend payments, and then it also got additional money or cash flows from issuance of debt and then sale of short-term investments. All right. Now let us do some performance evaluation. To do performance evaluation, we're gonna measure some ratios. First one is return on invested capital. So return on invested capital actually measures the amount of net operating profit after tax per dollar of operating capital. That means for every dollar of operating capital investment, how much net operating profit after tax you get. So naturally, you want to see a higher value of return on invested capital. The higher the value is, the better you are. So net operating profit after tax, we calculated in the year 2021 is 300. Then total net operating capital in the same year is how much? 3000. Now the ratio is net operating profit after tax over total net operating capital. We are going to calculate the same ratio for the year 2020. Now let us calculate operating profitability ratio. So here we measure for every dollar of sales revenue, how much we can retain as net operating profit after tax. So you want to retain as much as possible from your sales revenue as net operating profit after tax. So the higher the value of operating profitability ratio, the better you are. Okay, net operating profit after tax, then sales revenue, then operating profitability ratio is NOPAT over sales. Again, we are calculating the same ratio for the year 2020. Okay. Next, capital requirement ratio. Capital requirement ratio measures for every dollar of sales revenue, how much you need to invest in net operating capital. So you want to generate more sales revenue for every dollar investment in your net operating capital. So therefore, in other words, you want to pay as less as possible for your in your net operating capital for every dollar of your sales revenue. So the lower the capital requirement ratio is, the better you are. So total net operating capital for the year 2021 is 3000. Then sales, again we are calculating the same ratio for the year 2020. Okay, now let us calculate market value added. So market value added is the difference between the market value of the firm and the book value of the firm. And the higher the market value added, the better you are, because the more value you get for your investment in the company. So market value of a firm is the product of the share price per share and then number of shares outstanding. So let us see what is the stock price of this company. The stock price of this company in the year 2021 is $31, and the number of shares outstanding during the same year is 60. Then the book value of total common equity. The book value of total common equity, you can see here in the year 2021 is 2,240. Then market value added is stock price times number of shares minus total common equity. Okay. Next, market value added in the year 2020. Again, stock price per share in the year 2020. The number of shares outstanding. Next, book value of total common equity. All right, so now you can see market value added in the year 2021 is the negative 380. That means the company is traded 380 below its total common equity. On the other hand, in the year 2020, the company was traded 648 above its book value of total common equity. And you always want to see your company traded above the book value of total common equity. Yeah. Next, economic value added. So economic value added is the residual income that remains after the cost of all capital. Okay, so let us first get net operating profit after tax, which is our income. Now, let us reduce our net operating profit after tax by the cost of capital to get our residual income. So, to get cost of capital, we are going to apply weighted average cost of capital over our net operating capital. Our net operating capital in the year 2021 is 3,000. Our weighted average cost of capital 11.5%. So economic value added for this firm is negative 45. That means the company has negative 45 residual income in the year 2021. So you should not be happy because the company actually generated 45 less lower $45 million less than its total cost of capital. Okay, now we need to calculate economic value added for the year 2020 in the same way. So net operating profit after tax is 330. Then operating capital for this year is 2,490. Then weighted average cost of capital now let us calculate economic value added. So economic value added in the year 2020 is positive $44. So you should be happy for the year 2020 because the company generated more than its minimum cost of capital. That means the company had positive residual income in the year 2020. All right, that's all from this lecture. Thank you.